Welcome to Talk Tickers, your essential deep dive into the most pivotal earnings calls, custom tailored for experienced investors like you.
Glad to be digging in today.
Today, we're dissecting a particularly dramatic one. The first quarter fiscal year 2026 earnings call for C3.ai Inc., ticker AI. It delivered a hefty dose of both pain and promise after market close on September 3rd, 2025.
Yeah, it definitely made waves.
Our mission today is really to cut through the noise, extracting the most vital insights from C3.ai's recent performance and their, bold strategic pivots. We want to give you the clarity you need to grasp this company's direction and its market implications.
It was certainly a quarter that caught us straight off guard.
Yeah.
I mean, for anyone following C3.ai, the Q1 FY26 numbers were, let's just say, a significant disappointment.
Significant is maybe putting it mildly. Let's not mince words here. C3.ai reported a really challenging quarter. Financial results significantly missed consensus estimates, pretty much across the board.
Yeah, the top line was the big shocker.
Revenue for Q1 FY26 came in at $70.3 million. Now, that's a sharp 19% year-over-year decrease. Fell dramatically short of the $93.9 million consensus projection.
A 19% drop. Wow. That's jarring.
It almost feels like we're looking at a different company's report compared to expectations.
You're right. The top line was particularly jarring. And it didn't get much better on the earnings front either.
No, it didn't.
Non-GAAP EPS came in at a loss of 37 cents. The consensus estimate was looking for $1.21 loss, so another big miss there.
And GAAP.
On a GAAP basis, that loss widened to $1.86 per share. Now, interestingly, they did report a non-GAAP gross margin of 52%.
Okay, so margin holding up a bit.
A bit.
Right.
And their cash and securities balance remained pretty robust at $711.9 million. But, those points couldn't really overshadow the huge revenue and earnings misses.
The market certainly agreed with that sentiment. Following the call, shares of AI dropped approximately 13.7% in after hours, trading from their pre-call levels. It was a clear, almost visceral reaction, signaling, I think, a loss of confidence that went beyond just the headline numbers. It felt like a corporate confession, a leadership overhaul, and maybe a desperate pivot all rolled into one.
That market reaction wasn't merely about the numbers, was it? It speaks to the gravity of such a wide deviation from expectations, especially for a company in a high-growth sector like AI.
Exactly. It wasn't just a miss, it felt like a fundamental challenge to their narrative.
A real narrative breaker.
Okay, so if those are the stark headline numbers, what's management saying about why things went sideways so dramatically? Executive Chairman Tom Siebel himself was incredibly candid. He described the Q1 performance as completely unacceptable.
Strong words from the founder.
For an experienced investor, how do you typically weigh that? A founder's candid personal attribution for such a significant miss. Is it refreshing transparency, or does it raise red flags about accountability, maybe foresight?
That's a crucial question, isn't it? And it immediately puts investors in a bit of a dilemma. On one hand, Siebel's transparency is unusual, attributing, 70% of the impact to a sales and services reorganization?
Right, 70% to the reorg.
And 30% to his own unanticipated health issues that limited his active involvement. He specifically said, in hindsight, it's clear that my active involvement in that sales process had a greater impact than any of us knew. That level of directness can build trust. However, on the other hand, attributing 70% to an internal sales reorg, a decision management controlled, and 30% to personal health, while understandable.
Yeah, you have to wonder.
It might prompt investors to ask why these issues weren't mitigated sooner, or if there are deeper systemic problems maybe being masked. It signals a company really grappling with internal execution.
Right.
And for some, it might feel like a, convenient explanation for a much larger miss than anyone anticipated.
So a potential deflection, or maybe a genuine mea culpa, setting the stage for a real reset. And what a reset it seems to be.
Huge changes.
In response, C3.ai has fully restructured its global sales and service organizations. They're bringing in new, highly experienced leadership. We're talking a new chief commercial officer, general managers for various regions, plus significant new leadership in federal business operations.
This isn't just a tweak, is it? It's a top-to-bottom shakeup.
Exactly. It's a profound overhaul that culminates in a major leadership transition. Stephen Ehikian has been appointed as the new chief executive officer effective September 1st, 2025.
And this isn't just a fresh face. Ehikian brings a truly impressive resume. Successfully built and sold 2 AI companies to Salesforce. That catches the eye.
Definitely.
And critically, for a company with C3.ai's big federal focus, He also served as acting administrator of the General Services Administration under President Trump. Apparently drove the administration's AI strategy across the federal government there.
So a very experienced hand taking the operational helm, someone who understands both enterprise sales and the, let's say, labyrinth of federal contracts.
Exactly. That dual experience seems highly relevant.
So a new CEO focused on operations, but Tom Siebel isn't stepping away entirely, which is also a significant point.
Right. He's staying on as executive chairman.
He confirmed his continued active engagement, focusing his, formidable experience on strategic partner relationships, strategic customer relationships, and product strategy.
So it's a new operational lead with the founder still guiding the strategic vision and bringing his decades of deep relationships to bear.
It could be a powerful combination, couldn't it? Or it could lead to friction if roles aren't crystal clear.
That's the tension for investors to watch, I think. The founder remaining engaged can be a huge asset, especially for those high-level deals and product vision, but the day-to-day execution now rests squarely on Ehikian's shoulders.
Okay. Now, with management owning up to the sales execution issues and undertaking such a dramatic restructure, let's drill down into the financial engine itself. How healthy are their core revenue streams, like specifically subscription revenue, in the midst of all this turmoil?
Well, subscription revenue for the quarter was $60.3 million. That made up about 86% of total revenue.
Okay, 86%, that's good for recurring.
Yeah, that's a healthy percentage for a software company. You definitely want that recurring revenue. Professional services revenue contributed $10 million. And it's noteworthy, these services maintain a strong non-GAAP gross margin, over 80%.
Over 80% on services. That's pretty strong.
It is. It suggests that while they might have struggled to close new subscription deals, their existing services work is still highly profitable.
That's a bit of a silver lining, I guess, but the broader financial picture was certainly challenging beyond that. The non-GAAP operating loss for the quarter was $57.8 million.
Right, a significant loss.
They also reported net cash used in operating activities of $33.5 million, resulting in a negative free cash flow of $34.3 million.
Yeah, the cash burn is definitely something to watch.
So while that substantial cash balance provides a runway, operations are currently burning through that cash. That's a critical point for any growth investor, isn't it?
It absolutely is. And this brings us to one of the most impactful pieces of news from the call. The guidance.
Ah, yes, the guidance, or lack thereof.
Right. For the second quarter of fiscal year 2026, C3.ai guided revenue to be between $72 million and $80 million.
Which, again, fell well short of street consensus. That was around, what, $99 million to $100 million?
Exactly, a big gap still. And the non-GAAP operating loss for Q2 FY26 is projected to be between negative $49.5 million and negative $57.5 million. So still significant losses expected.
And here's where it gets really interesting and frankly a bit unsettling for investors, I imagine. The company completely withdrew its full-year FY26 guidance.
Yep, pulled it entirely.
They cited the new CEO appointment and the ongoing sales and services restructuring as the reasons. Said they plan to provide guidance for Q3 and the full year when Q2 results are announced. For us experienced investors, what does a full-year guidance withdrawal really signal in this context?
Exactly, the withdrawal of guidance. I mean, while they frame it as a prudent move during a CTO transition and restructuring, it effectively puts C3.ai into a black box for the next quarter, maybe longer.
Right, zero visibility.
For investors, this isn't just uncertainty. It's a lack of visibility that premium growth stocks typically can't afford. It forces a complete reset of valuation models and suggests maybe a floor hasn't even been found yet for their revenue projections. The true insight here, I think, is how deeply this erodes confidence in management's ability to forecast. That's a major hurdle for any turnaround story.
Did they give any hint at all about the full year?
Well, CFO Hitesh Ladd did note that analysts updating their forecasts anticipate fiscal year 2026 revenue to range somewhere between $290 million and $300 million. He didn't dispute that range.
Okay, so the street's already pricing in a significant downgrade from where they were before.
Oh, absolutely. Expectations have been reset dramatically.
So the immediate future is murky, to say the least. But let's shift our focus to their strategic initiatives and the partner ecosystem. This sounds like a critical part of their path forward, maybe the key to how they plan to regain momentum.
It seems to be the core focus now, yeah.
C3.ai officially launched its Strategic Integrator Program, or SIP. Can you maybe unpack what this OEM model means for their distribution strategy?
Absolutely. The SIP is basically designed to license the C3 Agentic AI platform to system integrators. So it allows other companies, these integrators, to build their own AI solutions on top of C3.ai's core technology.
Ah, okay. So leveraging others to build and sell.
Exactly. The program aims to scale distribution without needing that linear headcount growth, which is, crucial when your internal sales organization is in disarray, as they admitted.
Makes sense.
Management says it's being well received, particularly in defense, intelligence, and civilian government sectors. These are areas where integrators often have deep relationships and complex project expertise already.
So it's a smart move to leverage external resources for market penetration.
It could be. But success depends entirely on the traction these integrators actually gain, right? It's an indirect model.
True. That makes a lot of sense, especially given the internal sales challenges. They also highlighted significantly expanded alliances with key partners like Microsoft and McKinsey.
Yeah, the partner angle is huge now.
And here's a truly surprising fact that really emphasizes this new direction. An impressive 90% of deals closed this quarter were partner-led.
90%. That's incredible.
Involving major cloud providers like Azure, AWS, GCP, and McKinsey Quantum Black. C3.ai plans to significantly increase joint selling engagements from hundreds to thousands with these partners.
Wow, that's not just a shift. It's almost a complete reliance on external channels.
Feels like it.
It is a radical shift and, a direct response to their internal sales execution problems. That 90% partner-led figure is astounding. It suggests that while C3.ai might be struggling with its own direct sales force, its technology is finding pathways to customers through these powerful channels.
So opportunity and risk there.
Exactly. It represents both a massive opportunity for scalable growth and, potential dependency risk, too. The quality and type of deals coming through these channels, the revenue share models, that'll be crucial to analyze going forward.
And they did mention some big customer names, too.
They did. They highlighted notable customer wins and expansions, including Nucor, America's largest military shipbuilder, HII, the U.S. Army, deploying a contested logistics application on the C3 Agentic AI platform, apparently.
Interesting. Federal traction still there.
Yeah, and Lawrence Livermore National Laboratory, LLNL, and global chemicals leader, Kamea, which is scaling its enterprise AI program to 100 assets. These are high-profile, sticky customers, which suggests the underlying product value remains strong despite the sales issues.
Okay, you mentioned the C3 Agentic AI platform. This term is getting a lot of buzz. For our experienced listeners who might not be deep into the bleeding edge of AI nomenclature, what exactly makes it agentic, and why is C3.ai touting its success with large language models, or LLMs?
That's a great distinction to make. So unlike maybe some general-purpose LLM tools, C3.ai's Agentic AI platform is designed to, autonomously initiate and complete complex enterprise tasks. It handles everything from data integration to compliance, all within a specific business context.
So it does stuff, not just talk.
Kind of. Think of it as an LLM that can not only understand a request, but also act on it across various enterprise systems, often without direct human intervention for every step.
Gotcha.
And they specifically touted its ability to successfully deploy LLMs by solving common enterprise challenges. Things like data exfiltration, preventing sensitive corporate data from leaking out.
Big concern with LLMs.
Huge. Also cybersecurity risks, hallucination, where LLMs just make stuff up.
Yeah, the confidently wrong problem.
Exactly.
Yeah.
Also the inability to enforce data access controls and omnimodal integration, meaning it can process and integrate data from all sorts of different formats and sources. This success rate, they claim, contrasts sharply with broader industry reports on LLM project failures. So they're positioning their platform as a more reliable, enterprise-ready solution.
That's a critical differentiator if it holds true, especially in a market really grappling with the practicalities of deploying these LLMs effectively.
Absolutely.
Management reiterated the enormous market opportunity for enterprise AI. Some estimates approaching, $2 trillion annually?
Yeah, massive numbers being thrown around.
They're clearly aiming for global market leadership in enterprise AI applications. But with such a massive market, what makes C3.ai's focus on applications truly stand out? Is it a defensible moat against the bigger players, the cloud giants?
Well, it's a critical distinction, as you say. They're not trying to build the foundational models themselves, right? Or compete directly with the hyperscalers on basic infrastructure.
Right.
Their focus on applications means they're aiming to deliver ready-to-use AI solutions for specific industry problems. Think manufacturing, oil and gas, federal.
Got it. Vertical solutions.
Exactly. This can be a defensible niche if their vertical expertise and their platform capabilities truly solve complex enterprise problems better than generic tools can. The key question for investors, I think, is whether their agentic AI approach creates enough unique value and stickiness.
So customers won't just build it themselves or use generic cloud tools.
Precisely. It's a bet on specialization and deep domain knowledge, which, in a potential $2 trillion market, could carve out a very significant share if they execute effectively.
Okay, so connecting all these dots, what does this highly eventful quarter mean for investors moving forward? The market's immediate reaction, as we discussed, was cautious to negative. And frankly, this wasn't entirely out of the blue, was it?
No, not entirely. It followed those lead-up events in August where they put out that preliminary revenue guidance, a significant 33% reduction.
Right, that caused a 25% one-day stock sell-off and those catastrophic analyst downgrades from firms like D.A. Davidson.
So the market has already been conditioned for some level of disappointment. Going forward, investor attention will largely be on the company's ability to, first, rebuild that sales productivity.
Job one.
Basically, job one. And crucially, to convert its 54% year-over-year increase in partner pipeline into actual durable subscription revenue.
Turn that pipeline into dollars.
Yep. And they also need to demonstrate a repeatable return on investment from these agentic workflows they talk about. These are the concrete metrics that will signal whether the restructuring and the new leadership are truly working.
Despite these near-term challenges and the cash burn we saw this quarter, that substantial cash balance, $711.9 million, it does provide a significant financial runway, doesn't it?
It's a crucial buffer, yes. Yeah. Allows them time to invest through this transition, this period of profound uncertainty, and execute their turnaround strategy.
That cash position is absolutely vital. Management remains committed, they say, to achieving non-GAAP profitability and positive free cash flow. They view it as a matter of time, with the right scale and execution under the new leadership.
Which raises the important question, right? Can they stabilize operations and capitalize on this enormous market opportunity quickly enough?
Before that impressive cash pile significantly erodes.
Exactly. It really feels like a race against the clock now.
So for those watching C3.ai closely, what are the key indicators? What are the signs of a turnaround, potential upside catalysts we should look for?
Okay, I think investors should be looking for several things. First, obviously, the Q2 results and any reinstated full-year FY26 outlook. That will provide much-needed clarity on management's renewed confidence or lack thereof.
Right. Show us the number.
Second, early wins and actual deal flow from that Strategic Integrator Program, the SIP. That'll show if that scalable distribution model is actually gaining traction.
Proof of concept for the partner strategy.
Third, updates on those large enterprise rollouts like Nucor and just sustained traction through key channels like Microsoft. That indicates customer validation and real growth.
Makes sense.
Ultimately, investors will be looking for revenue to begin tracking closer to those prior street run rate expectations, around $100 million plus per quarter, and an improving loss profile.
And the risk.
Well, another soft guidance report, another big miss that could continue to pressure shares against broader software benchmarks. This company is definitely in a high-stakes transition period.
All right, investment committee, let's get wild here. Given the market's visceral reaction to C3.ai's earnings and this dramatic leadership reset I'm proposing, a phoenix from the ashes, long straddle on AI for the January 2027 expiry.
Wow, okay. A truly bold move, considering the recent performance and, well, the significant uncertainty that still surrounds the company. What's the core thesis behind playing for that kind of high volatility?
Hear me out. Tom Siebel himself admitted the quarter was dreadful, but immediately pivoted to, we're going to be rocking. That's classic founder energy, right?
It is very Siebel, yeah.
And with a new CEO, Stephen Ehikian, who successfully built and sold 2 AI companies to Salesforce and led President Trump's AI strategy for the federal government. This isn't just a simple turnaround play in my mind. This could be a potential slingshot.
Oh, slingshot. Okay.
The current withdrawal of guidance and the low revenue base for Q2, while optically really poor, could actually be a shrewd strategy. Underpromise and overdeliver as the new leadership takes hold.
Setting a low bar to clear.
Exactly. And that SIT program, if it gains traction, offers a truly scalable distribution model. It bypasses that linear headcount grace issue and could unlock significant enterprise AI adoption. Plus, the federal contracts, major industrial clients like Nucor and HII expanding, it shows underlying product value. The tech seems to have legs.
So you're betting on the potential for a massive upside swing if the new strategy and leadership actually click, while acknowledging the equally substantial downside risk if the execution issues persist. It's a pure play on extreme implied volatility.
Precisely. A long straddle protects against, well, the unknown. If Ehikian's restructuring in that partner-led growth strategy, especially with Microsoft, AWS, McKinsey, if it ignites the market and C3.ai starts hitting even slightly better numbers than their new, potentially sandbagged Q2 guide, this stock could explode upwards. That rewards the call options.
And the other side.
On the flip side, if the unacceptable execution issues persist, if competition truly catches up, or if the market just loses patience entirely, the downside could also be substantial, making the put options highly profitable.
So you win if it moves big either way.
Exactly. The point is, the volatility feels baked in here, and this straddle captures that optionality. With Siebel still as executive chairman, focusing on strategy and partnerships, and Ehikian handling the operational detail, it's potentially a potent combination of vision and execution experience. They have a massive addressable market, a tried, tested, and proven agentic AI product, they say. This isn't just a bet on a turnaround. It's a bet on strategic pivots and experienced leadership in a rapidly evolving trillion-dollar market that could, frankly, go either way dramatically.
High-octane bet for sure.
Okay, let's recap. C3.ai faced a highly challenging Q1 FY26. They reported significant misses and withdrew full-year guidance amidst a major sales reorganization and CEO transition. Big quarter.
The company now remains laser-focused on partner-led growth, its innovative Strategic Integrator Program, and trying to maintain that continued federal momentum under the new CEO, Stephen Ehikian.
Yeah.
Investors will be keenly awaiting signs of execution stabilization and improved financial performance in the coming quarters. That's needed to validate the company's long-term optimism. It's going to be a truly crucial period to watch.
As always, remember, this discussion is for informational purposes only and is not financial advice. We absolutely encourage you to do your own due diligence. The question for you, our experienced listener, is this. In the wake of such a dramatic corporate reset, does C3.ai's new leadership truly mark a new chapter? Or is it merely turning the page on what might be a persistent challenge?
A tough question.
We'd love to hear your thoughts on C3.ai's prospects. Join the conversation on our platform.